Every empire swears it ended when the flags came down. Britain is no different. The story goes like this. The empire collapsed after World War II, the colonies won independence, and the sun finally set on the British Empire. Except, it didn't. For decades after the Union Jack was lowered across Africa, Asia, and the Middle East, Britain still controlled something far more important than territory. It controlled the money. From the end of World War I through the 1970s, a hidden structure called the sterling area functioned as Britain's last invisible empire, a web of currencies, trade rules, and financial obligations that quietly kept dozens of independent nations tied to London's banking system, British exports, and British interests. No redcoats, no gunboats, just exchange controls, clearing accounts, and soft power wrapped in the language of stability. And if you look closely at how it worked, you start to see something unsettling. The empire didn't end. It changed costume. This is Empire Ledger, where money, power, and history collide, and nothing is ever as simple as it looks. We like to imagine empires as flags, soldiers, and maps shaded in imperial red, but the real empire, the one that lasts, is built out of contracts, currencies, and credit. You can kick out the governor, draft a constitution, raise a new flag. But if your central bank still lives in someone else's shadow, how independent are you really? The sterling area was Britain's answer to the end of formal empire, a financial architecture that kept trade, savings, and national reserves flowing through London long after the colonies became independent states. On paper, it was a system for cooperation and stability. In practice, it turned the pound into a leash. To understand how Britain built this invisible empire and why it eventually collapsed, we need to go back to the moment when London ruled not just an empire on land, but an empire in money. By the late 19th century, Britain had built the largest territorial empire in history. But the real power wasn't just the Royal Navy or the colonial administrations. It was the City of London. London sat at the center of a global web of trade and finance. If you were building a railway in India, you likely borrowed in London. If you were insuring cargo from Shanghai, you did it through London. If merchants in Buenos Aires were discounting bills of exchange, they settled them in London. All of this ran on a simple promise. The pound sterling was as good as gold. Under the classical gold standard, 1 pound could be exchanged for a fixed amount of gold. If you held pounds, you didn't just hold paper. You held a claim on something everyone trusted. So what did the empire do? It quietly aligned the periphery with the core. Colonies and dominions were encouraged, and sometimes required, to anchor their currencies to the pound. The Indian rupee, the Australian pound, the South African pound, the Irish pound. Dozens of currencies were effectively little moons orbiting the sterling sun. Their reserves were held in London. Their banking systems were modeled on British rules. Their trade was overwhelmingly settled in pounds. No one called it the sterling area yet. But the scaffolding was there, a network of economies whose financial heartbeat depended on what happened in London. Then, in 1914, that world ended. World War I exploded the old gold standard. Britain suspended gold convertibility, borrowed massively, and emerged from the war still powerful, but heavily indebted and weakened. The empire on the map survived. The balance sheet underneath did not. The interwar period was a financial balancing act that veered into self-inflicted disaster. After World War I, Britain tried to rewind the clock. In 1925, under Chancellor of the Exchequer Winston Churchill, Britain returned to gold at the pre-war exchange rate, even though the economy had been battered and prices had shifted. It was a prestige move, a national ego trip. Britain wanted the pound to look strong, even if the underlying economy wasn't. The result was predictable. British exports became too expensive. Unemployment rose. The domestic economy strained. But there was an even deeper problem. To defend the pound's gold value, Britain needed the world to keep trusting sterling. So London leaned on its empire. Again, dominions and colonies with reserves in London were urged to hold those reserves in sterling, not gold. Every foreign central bank and colonial treasury keeping its savings in London helped make the pound look trustworthy, even if the fundamentals were deteriorating. By 1931, the illusion broke. Under the pressure of a global financial crisis, runs on the pound, and falling gold reserves, Britain was forced to abandon the gold standard. For the second time in less than 20 years, the monetary foundation cracked. And this is the twist. That's when the sterling area was born, not as a gold-based club, but as a sterling-based empire. In 1931, when Britain cut its link to gold, the pound dropped. Many countries looked at the chaos and thought about protecting themselves. They could have broken away. Most of the empire didn't. Instead, they followed sterling down. The United Kingdom, the self-governing dominions, and most colonies, alongside a handful of independent countries tied to Britain through trade, chose to peg their currencies to the pound. This became the core of the sterling area. So what did it mean, in practice, to be inside this club? First, exchange controls. Members closely controlled how foreign currency left their borders, but within the sterling area, money moved far more freely. It was like a gated community for capital, high walls facing the outside world, relatively open pathways inside. Second, reserves. Central banks and governments in the area held major portions of their foreign exchange reserves in sterling assets in London, British government bonds, London bank deposits, and similar instruments. Third, trade. Much of the trade within this bloc was invoiced and settled in sterling. If you were a Commonwealth country selling raw materials to Britain, you were getting paid in pounds. If you were buying British manufactured goods, you needed pounds. On paper, this looked like a polite, rational system. Predictable exchange rates, lower transaction costs, integrated trade. Everyone supposedly benefited from the arrangement. In reality, it did something else. It locked countries into the British financial system. If your reserves sit in London, if your trade is priced in sterling, and if your own currency is pegged to the pound, your independence is conditional. Your economic weather is set by someone else's climate. Britain didn't need a formal empire to maintain power. It had something subtler, a monetary orbit that was very hard to escape. Then came World War II, and the sterling area turned from quiet architecture into Britain's life support machine. The war was ruinously expensive. Britain couldn't pay cash for the food, weapons, and raw materials it needed from its empire and allies. So it paid with promises. Colonies and dominions shipped grain, rubber, oil, metals, and soldiers. Instead of sending equivalent goods back, London accumulated sterling balances, IOUs owed to its partners, recorded as credits and accounts in London. By the end of the war, these balances had ballooned. India, for example, held enormous claims on Britain in the form of sterling balances. So did other sterling area members. Think about that arrangement. Britain received real resources in real time. The exporting countries, many still poor and underdeveloped, received numbers on a ledger in London, numbers that, in theory, could be used later to buy goods from Britain or converted into other currencies. In theory. In practice, there was a problem. If all these countries tried to cash out at once, convert their sterling into dollars, or demand a surge of British exports, Britain's weakened economy would collapse under the strain. So Britain did what debtors often do when their creditors are politically weaker. It negotiated, it delayed, it imposed restrictions. It tried to stretch the illusion that sterling was still as solid as it had been in the age of the gold standard. The war ended, but those sterling balances didn't disappear. They became the backbone of a post-war dilemma. How do you stop your former colonies from demanding full payment without admitting that the imperial center is, in fact, broke? While Britain was wrestling with this, the world's financial map was being redrawn at Bretton Woods. The new system that emerged after 1944 was built around the United States and the dollar. The dollar would be convertible into gold. Other major currencies would fix their exchange rates against the dollar. Institutions like the IMF and the World Bank would provide support and supervision. In blunt terms, the monetary empire moved from London to Washington. Sterling was demoted, but Britain wasn't ready to become just another mid-sized economy overnight. It needed a way to preserve some of its old centrality. That was the sterling area. For a few decades after World War II, the sterling area became a counterweight to the dollar world. Inside this bloc, currencies remained pegged to the pound. Reserves stayed in sterling. Trade with Britain was still structured in pounds. Many countries that had gained political independence chose, or were encouraged, to remain inside the system. They were told this meant stability, continuity, partnership, common history. Underneath the rhetoric, the logic was simple. Britain needed a captive base of demand for sterling so that it could keep running deficits and borrowing cheaply, even though it had lost much of its industrial edge. To enforce this, Britain used tools that sound technical but were deeply political. Exchange controls that made it difficult to move money from sterling into dollars. Trade preferences that channeled Commonwealth exports toward the British market and British exports back the other way. Informal pressure on central bankers and finance ministers who had been trained in British institutions and thought in sterling terms. It looked like cooperation. It felt like habit. It functioned like dependence. Throughout the 1950s and 1960s, the political map of the empire changed rapidly. India and Pakistan, Ghana, Nigeria, Kenya, Malaysia. A cascade of new flags went up. New national anthems, new parliaments, new constitutions. But political independence does not automatically bring monetary independence. For many of these states, the path of least resistance was to keep their currencies pegged to the pound, keep their reserves in London, and keep trading in sterling. Building a credible independent currency is hard. Pegging to a familiar one is easier, especially when your main export market is still the old imperial center. The cost of that choice only becomes clear when the anchor moves. Britain devalued the pound in 1949. Overnight, sterling lost a chunk of its value against the dollar. Every country tied to the pound devalued with it. Their reserves, held in sterling, lost purchasing power on world markets. Imports priced in dollars got more expensive. Development plans that assumed a stronger currency suddenly faced new constraints. They did not get a vote in that decision. They simply paid the price. The pattern repeated in the 1960s. Britain was struggling with chronic trade deficits and weak growth. Its industrial competitors were rising. Defending the pound's external value against the dollar required repeated austerity at home and quiet pressure on sterling area partners to keep holding sterling. By 1967, the strain snapped. Britain devalued the pound again by about 14%. Once more, sterling area members woke up poorer in international terms. Once more, a domestic decision in London rippled out across continents. By now, the illusion of equal partnership was wearing thin. Newly independent countries were asking harder questions. Why were they keeping their national savings in a currency that seemed to slide every decade? Why was their monetary policy effectively outsourced? Why did their economic fate hinge on decisions taken in a parliament where they had no seats? At the same time, the global system itself was shifting. In 1971, the United States effectively ended the dollar's convertibility into gold. Bretton Woods cracked. The world moved toward more flexible exchange rates and a more openly political monetary system. Without the gold anchor, everything became more obviously a matter of power, confidence, and negotiation. In that world, the sterling area's foundations looked even shakier. One by one, countries began to diversify. They shifted reserves into dollars, Deutschemarks, and other currencies. They loosened their ties to the pound. Some left the sterling area altogether. By the mid-1970s, what had once been an extensive financial empire stretching across continents had shrunk to a shadow of itself. The sterling area, as a coherent system, was effectively over. No dramatic farewell. No official end of empire ceremony. Just a slow unwinding of currency pegs, reserve holdings, and habits that had kept half the world in London's orbit. If you step back from the chronology and look at the structure, a clearer picture emerges. The sterling area worked through four main levers. Reserve dependency first. By keeping other countries' reserves in London, Britain turned them into a captive investor base. It could run deficits and issue debt with a guaranteed audience. Those countries thought they were holding safe assets. In reality, they were financing the center. Trade denomination, second. When trade is invoiced in your currency, others need that currency to function. That creates ongoing demand for your money, whether or not it reflects your real economic strength. Exchange control walls, third. By making it harder to exit into alternative currencies, Britain bought time in every crisis. Capital couldn't flee as easily. Pain could be distributed and delayed. And finally, prestige and habit. For generations, sterling had been the world's premier currency. Policymakers, bankers, and businessmen had grown up inside that mental universe. Even after the reality shifted, the psychology lagged. People continued to act as if the pound was central long after the balance of power had moved. Put these levers together and you get something that looks very familiar. An informal empire with no colonial office, no imperial titles, and no official borders, but very real consequences for those living inside it. Which raises a question. Why should any of this matter now? Because the pattern didn't die with the sterling area, only the names changed. Today, a different currency plays the role sterling once did. A different central bank enjoys the privilege of issuing the money that others must hold as reserves. A different government can run persistent deficits in its own currency, while the rest of the world absorbs its IOUs under the label of safe assets. The architecture is the same. A core that issues the reserve currency and sets the tone. A periphery that pegs, holds reserves, and settles trade in that currency. A language of partnership and stability that obscures the asymmetry of power. The sterling area is a reminder that empires do not end when the colonies become independent. They mutate into financial systems. The color on the map fades, the ledgers remain. It is also a warning about sovereignty. We are taught to think of independence as a flag and a constitution. History suggests a harsher test. Who controls the money? Who sets the terms of credit? Who can devalue and externalize the cost? If the answer is someone else, the independence is partial, no matter what the speeches say. You can watch this play out in real time whenever countries debate what to hold in their reserves. Dollars, euros, gold, something else. Behind the technical language is the same struggle that once defined the sterling area. Who holds whose promises, and who gets to default, devalue, or delay. The story of the sterling area is not just a footnote in British monetary history. It is a case study in how power survives defeat by changing form. The gunboats go home. The governors leave. The constitutions are rewritten. But the contracts, the pegs, and the payment systems quietly carry patterns of control into the next era. Britain's last invisible empire was built not on conquest, but on clearing accounts and currency rules. For decades after the empire supposedly ended, the City of London lived off a structure that kept other nations' savings in its hands and their monetary policy in its shadow. When politicians talk about independence, partnership, and sovereignty, it is worth asking a simple question. Who controls the money? If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.